Schönen guten Tag and good afternoon to you all. Q1. Before we start with the formal presentation, allow me some remarks. We live truly in some unusual times, especially those of us, which include me, who think they have been around the block for a few times, find that unusual that we have an order backlog which is record. Even in Q1 we have an order intake which is again a record, and at the same time we have all these issues and troubles with the delivery of material and supply chain problems, and the war at hand and the difficulties coming out of COVID, especially from China. So we have enough work, which is lovely, and we have to put it through the company, which is demanding, and I think that is why it is so unusual, and also a lot of things are very difficult to predict in these times. Having said that, let's look at the first quarter in the usual way. I think a fair summary would be that we hold our own in our economic climate, which you can describe as gloomy, but if you look at our order intake, it isn't. But if you look at the environment and the world and the war, it probably is. The bottleneck is the pandemic, especially in China, the hard lockdown on the harbors. But also in the first quarter, we had still quite an amount of sick people who couldn't attend because they were quarantined, though they were not seriously ill. So there's still COVID impacting us, and the associated material bottlenecks are probably something which nearly everybody in the business experiences. And of course, material and energy costs increase. In the first quarter, we have a record order intake, and we are putting that on top of our historically high order backlog. Despite many circumstances, which Stephen Kimmich will describe in greater detail, we slightly improved the EBIT as compared to the first quarter of last year. And what I think is very important, the share of our service revenue increased. That is especially important because that was also affected during COVID times and travel restrictions. That is going much better now. In the segments, we have a double-digit order intake in all segments. The special segments has especially good sales growth in this quarter. On the earnings side, the segments reacted differently to the pandemic situations, and the details will again be explained later on by Stephen Kimmich. Our big program P24, which is still driving a lot of daily meetings, sessions, and pushes, which we have to do as a management, is now realistically in its seventh quarter of where we do it. We started in late 20, and it is still, after 7 quarters, on track. And the savings which we plan to achieve in the first quarters, we have achieved more or less. I think the deviation was less than a few percent. So such a large program over 7 quarters on track means that we pay high attention to it, everybody in the organization, otherwise it wouldn't have been possible. Fundamentally, we have intact end markets, and I think that's why I would like to end my Q1 at a glance with a positive note. I think we are lucky, or you can say it is the fantastic wisdom of the executives, but I think a bit of both. But in strategy and in luck, we are very, very well positioned in the end markets of food, beverages, pharmaceuticals, and cosmetics. And especially food and drinks are not affected by all of the external circumstances which we have, which is probably the main explanation why we're doing fairly good, and I'll explain that later, better than our part of the business in order intake. If we turn over one page, please. Here you see what I've just explained in a few charts. The first chart shows the order backlog and the order intake. If you look Q1 22 and compare it with Q1 21, you see both in order backlog and in order intake an increase, and especially in order intake, it was the record quarter which we had. I don't know for how long but as long as at least I can think back. Revenue in Q1 as 22 as in Q1 21 dropped slightly. Stephen Koenig will explain that. It has only and entirely to do with the hiccups which we have in the supply chain, and to a certain extent also with a certain amount of COVID cases which we have in the company, where a few days fell away. The EBIT, as I've explained, quarter over quarter is slightly better, or you could say just about the same, but that in an environment with many factors to be looked at, and an environment where we no longer take Kurzarbeitsgeld, short-time workers compensation. I think the most remarkable chart is on the bottom right. These are numbers from VDMR in our type of business, in the printing business, and the average in this quarter in order intake was minus 5.9%, whereas we had plus 22.1%, and the revenue figure is minus 20, whereas we had only minus 2. Again, my short summary would be, because we're in the right markets, and probably also with good products or with the right products, but we're in the right markets. Food and beverages is just very stable. We've given you a few examples on the next pages. If you turn back to page 4, please. Sustainability goals is something which we take very seriously. We have already publicly announced that we want to be CO2 neutral by 2030. We will plan a complete conversion of our procurements and do all sorts of things which I don't want to go into detail. The news today is that we are probably, as far as I know, the first one in our business who is publishing Scope 3 emissions. I assume that you're all familiar with it. Scope 3 emissions is the emissions which our equipment triggers when it is under operation with the customer. And we will also announce in the next few weeks publicly ideas and measures and software and controls of how these CO2 emissions from our machines can be reduced, because we all believe that in the future will be a sales tool. Maybe some remarks on the side. I hope I don't repeat myself from last time. I don't think I told you. I've made a trip through the US several times in the past quarters and spoke to customers and asked the customer, is sustainability in the US as important as it is here? Because obviously we have the EU, which is busy in inventing a new regulation every day except Saturdays and Sundays. And you don't have the EU, and especially if you're in Texas or in Tennessee or wherever I was visiting customers, they are probably not, government regulation in their states is not very high. And they said, in our country it's probably worse, because you only have the EU. We have the young people. We have the young people in the social media, and they broadcast things. And they are like swing voters in an election. So if 80% of the people who go to McDonald's don't care about what McDonald's does, 20% care if they have styrofoam boxes or if they have plastic straws. And if Burger King doesn't have them, they go to Burger King. And they are the swing voters, and they change the business. And social media changes the business. We didn't have a ban on plastic straws. We had pictures going viral of a turtle, a sea turtle, which suffocated because it had 2 plastic straws through its nose. It was lying on the beach. And after that, a picture went viral. Plastic straws came out of the picture. So what we have as a checks and controls and environment is social media and the young generation. And even if they only represent something like 10 or 15% of what people really think, they are the so-called swing voters, and they will make businesses successful and unsuccessful. So sustainability for us is a big thing. I thought it's not exactly a topic for a presentation amongst you, but the sustainability thing is more than to follow regulations. It will, in my firm mind, it will be one of the parameters under which in the future the customer relationship will be chosen. On the next page, digitalization, just also a little example. We call it a job optimizer. It's a software tool. It's a planning system for prints on the machine. It optimizes costs, make ready and throughput times, deadline compliance, and is integrated with MIS and MES with our customers. And in the future, that will be upgraded in also measuring electricity input and other CO2 output. So that is maybe a little example of what we mean when we talk about digitalization. The next page is another example where we are, I think 2016, we have acquired Iberica in Spain, and we have launched a strategy of moving into post-print, which we later on extended by buying Duran in Turkey, of which we're also very happy. Koenig Bauer Iberica is doing good. We just moved the businesses into new premises. We introduced a new assembly process to expand production. And also, let's say the short and midterm order entry in post-print to us looks quite promising. So we believe that also in the integration of the whole printing process from the machine to the ready-made folded and glued box is something where we are well positioned. Now we turn over to the exact figures, and I hand over to my colleague Stephen Kimmich. Please, Stephen.
Thank you very much, Andreas. And good afternoon or good morning to all of you as well from me. And I will now walk you through the next few slides and go deeper into the figures. As already said, if we look at the top line development in Q1, it was again on order intake and order backlog, absolutely fantastic. So order intake up 22% versus prior year at 349 million euros. And that brings our order backlog now to 917.5 million. If you remember, in Q3 of 2021, we announced the historically highest ever order backlog at 860 million. And now we have topped that at 917.5. So again, the demand for our machines remains strong, and our order book gives us a lot of potential for the future. But as mentioned, the main challenge in the company is getting order backlog into production and into sales. So revenue was difficult in Q1, down slightly compared to last year at 238 million euros or minus 2.1%. And this again shows the challenges through the extreme business environment that's currently underway between COVID and logistics and inflation and war, that's clearly affecting our top line in the short term. If we move on to the next page, on the bottom line, on the EBIT, we're actually quite proud with a few items in the EBIT bridge because it was a very difficult quarter. And I would like to point out a few things. As already mentioned, P24X is still absolutely on track. So at 10 million euros in additional savings compared to prior year, which enable us to completely compensate the reduction of short time work, which in Q1 of last year was still a 5 million euro support. And P24X is clearly still proceeding on path in the way we expect. The second big message on this slide is that we were completely successful in compensating inflationary effects from material and from energy cost increases. Were completely compensated by price increases. This has been our strategy from day one when inflation became an issue around this time last year, or became more of an issue, that we have raised prices several times with a target to cover inflation. And this was a nearly spot-on achievement. We actually slightly overcompensated, I think 5.8 million in material increases and 6.2 in price increases. Overall, we're quite happy that we're on track in adjusting in pricing to our customers to cover inflation. But that being said, there's a lot of items in our business that have nothing to do with inflation, and this is the minus 4 million other effects. This is the remaining COVID. So we had very high sickness ratios in Q1 in most of our German facilities, predominantly German facilities with missed working days. We had, of course, material supply issues with not being able to have efficient production or efficient installations at our customers that caused delays or caused increase in costs. We had some, after Q4, writing off quite a bit of our Russia and Belarus business. We also had some write-offs now in Q1 for some customers in Ukraine. Not a major issue, but it's still a one-off that affected Q1, and other types of operational issues that reflect the difficult business environment we're in today. But still, we were able to slightly outperform prior year and completely compensate the inflationary effects. And now, of course, our day-to-day management challenge is to continue to address as well as possible these other disruptions in our business. If we go to the next page, on page 9, we move more in detail onto the financial statements. From the P&L side, I mentioned nearly all topics. Revenue slightly down. We had an increase in gross profit from 56.1 to 62.2 million compared to prior year. R&D costs are slightly increased as we start to amortize the capitalized R&D costs from the prior years. Otherwise, no major highlights in the P&L. Distribution costs remain under control. Administrative costs remain under control. And in this other income, the minus 2.3, you see some of these special effects, particularly some additional write-offs due to the war in Russia and Ukraine. At the bottom line, we now have a negative 8.5 EBIT, slightly better than prior year, and net loss, negative 10.5, also slightly better than prior year. On page 10, on the cash flow statement, you see that we had an increase in working capital. I think this should not be surprising. We still have very, very good working capital management installed at Koenig Bauer. You saw this throughout all of 2021. In 2022, we had, due to the high order backlog and order intake, of course, we're building up working capital, material inventories, also due to the extended lead times for our machines, getting them installed at customers, increase in receivables. Overall, 19.3 million euro negative cash flow from basically working capital increase, and on top of this is negative 10.7 cash flow from investments. So that yes, Q1 was negative in terms of cash flow, but this is all in preparation for working through our order backlog that we need to get through our plants and installed at our customers in the coming quarters. And even now, an order backlog that stretches well into 2023. So the negative cash flow is temporary. It's adjusting the levels to the current order backlog. On the balance sheet, there's no major items in Q1 to address. You can see on the specific items the working capital increase, whether it's inventories or trade payables or customer down payments. I think the only other significant impact in Q1 was again a reevaluation of the pension provisions as interest rates continue to increase from now 1.5 to 2.2% at the end of March. This, of course, is good for our balance sheet and good for our equity ratio. If we move on to the individual business segments, we mentioned some of this already. Sheetfed continues to perform in terms of top line, order backlog, and order intake phenomenally. This is also due to the strong focus on packaging, as already mentioned by Andreas Pletzke. After 6 straight strong quarters of order intake between 190 million euros, Q1 22 was an unbelievably high 242 million euros. So the strongest quarter in an already strong Sheetfed that we've seen the last year and a half, driving our order backlog now to over 550 million euros. This is, of course, our biggest segment and also the segment that is now on turnover and revenue, struggling with these challenges with COVID and with supply chain disruptions. So the revenue was down year on year from 145 down to 127 as we push the equipment through the facilities. Again, the order backlog should give an indication that we expect these effects to be temporary, and we just have to manage to get the equipment installed. If you go to digital and web, it's a similar picture as what we have shown in the past. We mentioned at the end of Q4 that we expected digital and web to have bottomed out, and we expect now to see continuous improvement quarter by quarter going forward. You see now in Q1 still losses, and that will remain in digital and web for the short future, but still a strong order intake, at least stronger than the weak quarters we saw in 2020 and early 21 at just over 30 million euros, which allowed us to increase order backlog to over 90 million. And here also, as we move through the rest of the year, the target or the challenge is clearly to book these equipment into revenue. The final segment, special, is a mixed picture. We had a very good order intake in the middle of last year. This is the most cyclical of our segments in terms of order intake. We still have a great pipeline of orders that we expect to book in the rest of this year. But even so, at 268 million euros of order backlog, still a good position moving into the rest of the year. And we had actually a year-on-year improvement in EBIT from minus 4 million to minus 700,000. And this also, moving forward, we expect special to continue to improve. Okay, and that being said, I hand back over to Andreas Pleske.
I already mentioned that P24 was performing in the first quarter as we predicted and as we planned it. The overall program is therefore obviously after now 7 quarters on track. 60% of the measures were installed in 21. They have a full effect in this year, and we have 30% to install in 2022, which will have their full annual effect next year. We are again well on track. It takes a lot of attention in the company. All of these steps are now, let's say, many small ones. There are no big hits. It's again administration cost reductions by bundling of shared services. It's optimization of production assembly plants. It's relocation and realignment of production assembly. I think last time we already mentioned that we are relocating the assembly of Flexotechnica into Würzburg, which will give us effects, and that will go on over this year. So it's a large number of operative measures which will more or less have an impact on the production cost of the equipment. The market outlook and forecast, if we turn to the next page, VDMR expects a production growth in the year 2022 of 4%. We have the solid basis in our backlog to do that. As we said, the only hindrance of the production is the supply situation. But otherwise, we're in alignment with the VDMR forecast. On the longer forecast, we are unchanged as to what we told you 5 weeks ago. First of all, what we told you was just 5 weeks ago. So has the world changed in those 5 weeks? No. So all in all, it's the same thing. We are confident and we have a positive outlook that on a year-over-year basis, we increase the operative EBIT margin in 2022 as compared to 21. And also our midterm goals of 1.3 billion turnover and an EBIT margin of at least 7% are confirmed. Since it was only 5 weeks, we find it difficult to come up with a number which is more than a wide range, and therefore we limit ourselves to this market guidance. Again, at this point, we will see how that goes over the next quarters. Last page, key messages. I don't want to lead you through this page. Just I believe that the situation that the market is in and Koenig Bauer is in and the world is in is something where we again don't have to lose sight of our midterm strategy and have to push our midterm strategy, because all we do in terms of strategy we think we've been doing well. First of all, by moving largely into the packaging market besides banknote. Secondly, by our new strategy of becoming more digital, more modular, and have a high emphasis on sustainability. And again, on the midterm, we believe that the market, since at the end it is consumers eating food and drinking beverages or using banknotes to combine it, is stable and probably growing. In packaging, we know it's growing. In banknote, we'll see it might not be growing, it might be a sideways, but it'll go in its direction. So therefore, we need to follow our strategy long term, and on the short term view, I think we now basically managing some things from quarter to quarter and from month to month and from week to week, because what we do is we have to stomp out these little fires which pop up every day when some parts are missing, or this is working, isn't working, or that isn't working. I believe in general Koenig Bauer is well suited to deal with difficult times. It has a great talent of improvisation. We've shown that many times in the past when we went through difficult times. So I remain fairly optimistic that we'll make it through these situations in a very reasonable way. That would be my closing remark. And then I hand back to the lady who's handling this conference.
Thank you so much. Ladies and gentlemen, at this time we will begin the question and answer session. Anyone who wishes to ask a question may press star followed by 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star followed by 2. If you're using speaker equipment today, please lift the handset before making your selections. Anyone who has a question may press star followed by 1 at this time. One moment for the first question, please. The first question is from the line of Stefan Augustin from Warburg Research. Please go ahead.
Yes, hello, gentlemen. I have actually a couple of questions. So maybe with the first one on sheepfed and the order intake. Is there anything special to mention about that? Is it across all products, or is it a specialty of a region, or can you give a little bit more color on that strong demand?
It's really globally and across all products. So it's mid-size format as well as large format. It's post-press. It's US. It's Europe. Also China. So I would not pick out one special product or one special region that's overperforming. We really see it across the board.
It's all about food. That is not regionally massively different.
Yeah. Okay. Great. So that sounds good. The next one would be actually if we look. I know you don't give exactly quarterly forecasts, but if I would ask you on your confidence that you have reached sales growth year-over-year by Q2, how would you feel about that?
I
don't think I got the question.
Do you think that Q2 22 will show the sales growth versus Q2 21 already?
Okay. I got you. Stephen, you want to comment?
Sure. I think, as you mentioned, we don't comment specific quarters, but clearly we're at -2% at the end of Q1, and we give a guidance that for the full year we expect to have sales growth. So that means in the next 3 quarters we have to outperform the prior year. It's that simple, by at least 2% pro rata. So whether that starts in Q2 already or in Q3, that's not something we guide for. But fundamentally, we're still positive moving into the next 9 months that revenue will increase.
Okay.
I would support that, and that includes the world of banknote. We have just come back from a large banknote conference with all the central banks, and that is always following its own rules. It's government business, nothing to do with all the other rules. But it remains unchanged. What I said before, there seems to be a robust pipeline.
Mm-hmm. So that was actually one of the other questions. So
okay. Sorry.
That is it's
not the question.
No, it was I was just wanted to ask if on the pipelines, especially if this includes banknote as well, but I think I can skip that one now. How about the new products of web and digital? Q1 orders were quite a bit below Q4. Is there something to be expected in the near term, or do you first need to digest the orders you got last year?
No, I think Q4 was a very great quarter, so it's always difficult to measure against the best quarter. But fundamentally, we're also optimistic on digital and web. We also have a very, very good order pipeline, project pipeline that we are working on with customers, particularly on the three big products in that segment for Rotorjet, for HP, as well as for the corrugated programs. All three of them, we're quite happy with the pipeline of projects we're working on, and expect to announce in the coming months also order intake in that segment.
I think the main difference you could say from the last year or years is now we talk about a pipeline, not a plan. And we do have a pipeline which looks very nice.
Mm-hmm. That's good to hear. The last one, the last bigger one is actually on the ESG part a bit. Do you think you will be able to partially put your products under the rules of taxonomy on the EU, or is it more that you would help to save CO2, but it will be difficult to get, let's say, the financial benefits from that kind of taxonomy program from the EU?
I think if you look at the taxonomy program, there are different levels of products which fall under different categories. If we start with the, let's say, oil-intensive products, and we end with the machine building. The machine building is at a bit of the lower end. So I think, and we are within this segment of the taxonomy, we are pushing it ahead. That's why we announced fairly early of what we want to do. Will this have a financial effect on us on savings? Could you ask again next quarter?
Yeah, sure. Definitely.
I can't say it's something intelligent to that. That hasn't been part of our equation yet. It has sustainability has been more in our mind as being at the forefront of it, as being something which is an enabler for sales and for certain customers who are also very sensitive.
Mm-hmm. Great. And the last one is a bit of a housekeeping. The extra costs on the write-downs with respect to Ukraine. Do I find that presumably I would find that in the sheet-fed division. Is that right? And is something like putting a 1 million amount to it a fair assumption?
It's also special. So in our metal printing business and some of the other businesses, not just sheet fed. But yes, it's less than the 1 million of that 4 million is due to write-offs. We covered nearly everything in our year-end closing, but that was the focus more on Russia and Belarus. And now with some of the Ukrainian projects, we're also making some provisions.
All right. Okay, that would have been it from my side. Thank you very much.
As a reminder, if you would like to ask a question, please press star followed by 1. Our next question is from the line of George Gonzalez from Hauck Aufhäuser. Please go ahead.
Hello, good afternoon, Andreas and Stephen. Thank you very much for taking my questions. Two questions for me, please. The first one is regarding this forecast from the VDMA for the production in 2022. If I understood well, Andreas, you were commenting that in a normal scenario, you are going to be able to increase your production above this 4% that is expected for the sector. So I am wondering what is preventing you to be more detailed in your sales forecast, if you believe that your production could be above this, as I imagine that this 4% volume plus the price increases could leave a very, very nice photo at the end of the year. And also, and in relation with this, what is the main or what is the most problematic point for you to increase your production? Is there any specific problem with any supply that is preventing you to increase your production, or what is the problem there, or how you can improve that? And my second question will be in relation with the margin for the year. I understand that you are doing very well with this cost savings, and so here my question is, taking into account the price increases that you are implementing or you plan to implement during the year, where do you see the upside in your EBIT margin for the rest of the year? Is purely economies of scale, or do you think that you are going to be able to introduce more price increases and thus to improve EBIT margin later during the year? Thank you.
I think I take the first question from you, Mr. Gonzalez. I think in your first sentence you mentioned the buzzword, under normal circumstances would we achieve the 4.4% of volume production increase. I think under normal circumstances we would easily achieve that within Koenig Bauer, because we have the backlog for it and we have the elasticity in the production to do that. But we don't have normal circumstances. That's the point. And you asked, what are the most problematic points? I think there are a long list. It is the unplanned arrival of necessary parts for our production. So we, as many businesses in the past, have worked on a fairly low stock and just in time, just in sequence delivery, probably not as fine-tuned as the automobile industry, but in what it was in our world. Now, if something is amiss, that means that the whole production line can stop. To give you an example, we have in Radebeul, we have, if we complete a machine and we need to complete it for our factory acceptance test, it's a machine which might be 30 meters long and 10 meters wide. If 3 control panels are missing, we can't do the factory acceptance test and the whole thing stops. And also all the other aggregates which are waiting for that space, because the space is limited, have to wait until that machine is accepted and then disassembled and put on a truck. So if one piece is missing at a critical late stage of time, that means the whole production process may be like in a queue on a highway. As an example, what do we do against that? The point with the panels and the electronic components, well, we put them on. We take those elements those parts which we don't have. We assemble them. We make the factory acceptance test, and then we disassemble these things again, put them on the shelf, ship the machine without these parts, with a missing parts list to whatever country, put the next machine there, use the same parts to run them off, and then complete the machine at the customer site in whatever, Indonesia, 6 weeks later, after hopefully the container has arrived there and we have these missing parts found somewhere. Secondly, some parts delivery people don't deliver anymore because they have a shortage, that especially in the ship industry. So a lot of things where we have to use other chips, other main boards from other suppliers. That means we need to reprogram to include them in our whole workflow. Thirdly, very little things. We have some suppliers from Southeastern Europe which are on the Ukrainian border, and they stopped making little parts because they were cut off electricity, because they get all of the electricity from Ukraine, and Ukraine was shutting down the nuclear power plants. So they didn't have electricity for a couple of weeks, which stopped their part flow to us. Then we have to look at alternative suppliers. Could we get it there, or could we do it ourselves? So it's a myriad of things. A lot of it has to do with the chip problem, the scarcity of chip. A lot has to do with the lockdown on the largest container harbor in the world in Shanghai. That is mostly electronics which we get from there. And a lot has to do with all other disturbance of our suppliers. In general, I think we fight that quite well because we have a fairly high level of vertical integration. So right now we actually have other companies from Germany asking us if they could please use our foundry because they can't get their foundry steel from today's sources. But that is a typical problem of what we have. Now, if we have this machine which I talked about, which needs the factory acceptance test, if that factory acceptance test is delayed by 2 weeks, it has a whole lot of effect on everything else which is in the waiting line. So missing a few existential parts has a ripple effect which goes through the whole production. We are not in an absolutely stage or step production as the automotive industry. In some parts, like in banknote, actually we are far away from it. It's special machines. But in sheet fed, it's somewhere in the middle. So wherever we are in a staged assembly workshop, if a stage stops, it's very difficult because one part cannot overtake the other part. So it's a day-to-day management of using parts, changing electronic components, reprogramming it with other chips. It takes a lot of time, which means money, which means inefficiency, and also we lose some time in shipping, which means we lose turnover because we make it later. So the last element is, of course, price increases, but Stephen mentioned that the price increases from electricity and parts in the first quarter we managed to fully compensate or even slightly overcompensate by price increase to the customers. So that in this quarter that didn't hit us. But the other 4 million, a part of these 4 million is what I just described. So what do we do against it? Let's say 1 million things, like finding alternative sources, but everybody else is doing the same. To give you another example, about 20% of the steel used in Europe is produced in Ukraine. We don't buy steel from Ukraine, but we buy steel from sources otherwise in Europe. Now everybody else in Europe who bought from Ukraine before now goes to these same sources in Europe where we buy. So therefore everything is in a kind of in a get what you can situation, and change parts, change chips, change programs, just try to get the machines ready to work and to the customer's plant to get the final acceptance. So it is what you can read every day in the paper, life and in color in our company. We are part of a complex supply chain, and missing parts can ripple the whole thing.
Thank you, Andreas. This is very useful. So this means that we should forget about the seasonality in the second quarter, or you expect an improvement, normal improvement, as the normal seasonality for the second quarter, or is the uncertainty so high that you really cannot say at this point?
Let's say my crystal ball, what world politics is about, what the war is about, what the Chinese lockdown in Shanghai is about, my crystal ball is probably not much brighter than yours. So how can we predict these things? In the next few weeks, we don't expect any change for the better or the worse. And in between, we manage this situation. We have managed it reasonably well in the first quarter. We're confident that we continue to do so. That's the reason why we continuously give you a forecast that this year operational profit will be above last year's. But it is a lot of uncertainties. It is still a lot of uncertainties. None of these things which I just mentioned, the ongoing uncertainty of the war, the supply chain difficulties, the lockdown of China, and the chip situation, nothing of that will change in 4 weeks. Will that change in 4 months or in 12 months? I don't know. I think we look forward that we have to manage the situation for the time being.
Thank you, Andrea. That's very useful. Maybe a last question. So at this level of sales, you are really close to break even, and so I was wondering, due to obviously the volatility that this situation creates in your production, any improvement from these levels should be quite positive, no, for your EBIT in general, because at the end you are controlling cost, and I also understand that you are having no problems to increase prices, no? Your clients are understanding this. Can you tell us if the lead times is still a problem for your margins, or is not anymore? You are able to pass through most of the cost of most of the raw material in price increases so far.
That was a lot of questions. First of all, if things would turn better on these elements of disturbances, would we increase our EBIT? Oh, yes. Because we have the contracts and we have them at a certain price level. So if things turn better, the answer is clearly yes. The second thing, where do we stand on the delivery times and the other questions, I would like to hand over to Mr. Kimmich.
No, I think most of the comments Andreas Pleska has already explained quite well. At the end, it's all about uncertainty. So, and I think the message we gave last time, and it's worth repeating again today, despite all of this uncertainty, and it's real, it's extreme. None of us have experienced this level of disruption on the market, basically ever in the recent last 2-3 decades of industry. It's never been as compounding of issues and just simple complexity in the issues. It's never been this extreme. So it's all about uncertainty. Despite this uncertainty, we still say in all of the scenarios we're running through, we expect to increase sales and increase EBIT over the prior year. And that's the good news. So that clearly, if these things settle down, the improvement will be better. If they don't settle down, it will be less. But in all of our scenarios, we still see our business as being on track. And that uncertainty is the reason we keep our guidance as it is, because of course there's upside potential if things settle down faster, if our disruptions in production are reduced and we can turn our order backlog into revenue faster. This is upside potential, also above the 4% that the VDMA is assuming for production. Clearly, there are scenarios where things settle down and we can get through our supply chain faster. On the risk side, I think we talked about enough. And also COVID is still not over. We still have it going on. But then Shanghai is probably an issue. The port issue probably won't hit us until the fall, maybe. We don't know. How will this shutting down the Shanghai port really affect supply chain? Again, nobody knows. The crystal ball is still cloudy. So we have upside scenarios and downside scenarios. And we think we understand our risk quite well. The inflationary risk we address primarily with pricing. I wouldn't say it's easy, but we are successful and in balancing pricing and inflation so far. We will see what happens the next 6 to 9 months. Is pricing adjusted correctly or not? Again, it's uncertainty. But we think we're managing the issues well and structured, and we are doing the things we can do under our control. Most of the uncertainty are things that are outside of Koenig & Bauer's direct control, and very much subject to either politicians or virus or ending wars and the such. So it's simply very difficult to tell you how will Q2 end or Q3 end or Q4 end. We will see.
Thank you very much, both. Very useful.
Let's stop on a positive note. We have the orders in house. If something goes better.
I think we're as well positioned.
Yeah.
The overall positioning is as well as we could expect it to be, and even better. And the order intakes in Q1 also for us were an amazingly, surprisingly positive note that the market's still strong and demand is still strong. So we're still optimistic, and that's always, my main message is exactly that. Despite all of this, the key takeaway should be Koenig & Bauer is still going to improve this year over last year, despite all of these difficult times. And we're heading and continue to head in the right direction.
Sounds good. Thank you.
There are no further questions at this time. I hand back to Dr. Andreas Pleska for closing comments.
I think the most perfect closing comment was just made by Stephen Kimmich. So all that's left to me is to wish you a good day and hear you in 3 months. And I will have an answer to Mr. Augustin's question by then on taxonomy.